Hello, everyone, and welcome to today's webinar, How Should I Organize?, where we'll be looking at legal business structures and their requirements. We appreciate you all joining us, and I want to go over just a few things before we jump in. So we are recording this session, and we'll send out an email later with a link to the video so you can have access to the material and the slide deck. We also welcome your questions, so feel free to type those in at any time throughout the presentation in the right-hand side of your GoToWebinar panel, and we'll make sure we leave some time for those questions at the end. We'll do a Q&A session. So I'm Hannah Curtis. I'm a coordinator with the North Metro SBDC, and I'm so happy to introduce to you our presenters today, Samantha Peaslee, attorney with Polaris Law Group, and Lauren Kmetz, founder of Antora CPA. Both are consultants with us at North Metro SBDC, and we feel so fortunate to have their expertise on this matter today. So with that, I will turn it over to you, Samantha and Lauren.
Thanks so much, Hannah. And welcome everybody as we get started in this. So this is, before we jump in too far, as you know, how should I organize? So the idea is that we're trying to give you some ideas of what the business structures out there for legal and tax purposes. Both of those are considered in here, even though we just say legal business structures on this first slide. However, I always want to say that if you have already chosen your business entity, that doesn't mean that this isn't also helpful for you. We can always make some changes. We can confirm that you've made the right choice. Sometimes you may learn that you do have the right business entity, but there are some things that you still need to do with it. So for anyone out there who has already launched and gotten a filing with the Secretary of State and you're listening to this and saying, oh no, I didn't do that right. This is also for you, and we're happy to help you with that here. Lauren, anything you want to add before we get started?
No, I think that's it. Let's dive right in.
Diving right in. All right, so legal disclaimer, this is not legal advice. I can only give legal advice if we actually sit down and talk to you about your individualized questions. If you do have individualized questions about your business, we encourage you, whether legal or tax, we encourage you to sign up for a consultation with the SBDC rather than to ask those in the chat today. We're going to try and reserve those questions for the ones that have a little bit more general applicability. So if you have a generally applicable question, please feel free to ask them. Otherwise, you can always sign up with something for both of us to consult with the SBDC. I am not a tax attorney. We have a lovely CPA here with us today who can give those, answer those tax questions. But again, Lauren cannot give you tax advice without knowing your tax situation. So today is more general educational information. So with that, let's jump in. When we're talking about what your choices of entity are, we're really talking about two different kinds of categories of entities. So you can have your entity has a legal identity and a tax identity. Those may be the same and they may not be the same. The legal entity is the one that you worry about for your Colorado Secretary of State filings, for your interactions with other people, for how much liability you have. Your insurance will care about what you are legally. Your tax entity is much simpler. There are fewer types of it, and it will matter for the IRS, the Colorado Department of Revenue, and those considerations. So legally speaking, your options start with a sole proprietorship, and we're going to go through each of these one by one over the course of the presentation. This is just your basic summary. Your legal options start with a sole proprietorship. That's when it's just one of you doing the business and you're one and the same with your business. Partnership, it's the same idea, but there's more than one of you. There are different types of legal partnerships, such as general, limited, limited liability, and limited liability limited. I know that one's a mouthful. That matter for the nature of the legal responsibilities in the partnership. However, with the IRS, it's just a partnership. I do have a lawnmower outside of my window now, so if anyone can't hear me, Lauren, I'm looking to you to just let me know at any point in time. Then you have your limited liability company, which is a more structured form. It provides more protection. And then finally, your corporations, which can be a C corporation or an S corporation. Versus with taxes, Lauren, do you want to talk about the different types of tax entities?
Yep. So we can have 4 major ways that a business is taxed. So the first is going to be for a sole proprietor or a single member limited liability company, which is commonly called an LLC, which we'll probably use a lot today. So those 2 are just reported on your same individual income tax return, which is your Form 1040, and then another additional form in that tax return called the Schedule C. So we have that, and then a partnership. So if you're an LLC with more than one person, it'd be a partnership, or any of these partnership structures that Sam mentioned. And then there's 2 different kinds of corporations for tax entities, an S corporation and a C corporation, which are taxed very differently. A C corporation is only a corporation. An S corporation can also be an LLC in its legal structure. So we'll get into all of these in a little more detail.
Yeah, the important thing for you to take away from this slide is that your legal identity may be different from your tax identity. So for example, Polaris Law Group, my company, we are a limited liability company or an LLC taxed as an S corporation. That's the way that we identify ourselves. So to start with the absolutely most basic one, the sole proprietorship. If you've ever had a lemonade stand, you're a sole proprietorship. If you're selling your crafts on Etsy, you're a sole proprietorship. If you're just testing the concept, you're a sole proprietorship. Sole proprietorship, you are one and the same with your company. As Lauren said, with taxes, when you file taxes as the same person. Whatever income your sole proprietorship gets, you get. If you are acting in the community, anything that your LLC does, or your sole proprietorship does, is imputed to you. Even if you change the name by doing a trade name, you're still one and the same. So when I talk about these, we're going to go through 3 categories for each of the types of entities: the formalities that they have to do, the liabilities that they carry, and then the tax situation for each one. These are the 3 considerations that you should make when choosing your company. So formalities means the types of paperwork and organizational structures that you have to do, the amount of work you have to put in basically to your company. So the sole proprietorship, absolutely no formalities are necessary. No documents are necessary. No EIN is necessary. You have central management. It's just you. You're making all the decisions. And we put, unless you're hiring employees for the EIN, that will always be the case. But even then, your odds are going to be that you're not going to stick with the sole proprietorship for long at that point, because you have to add those formalities. This is why the second that you're doing business for yourself, you're taking in money, you are a sole proprietorship. It's an automatic thing. Now, on the liabilities, you don't have to do any work on the formalities. Liabilities mean you have 100% full liability. You and your company are the same. Let's say, for example, that you're a babysitter and you are babysitting kids, and you decide to go take a phone call, and while you're taking the phone call, kid falls into the pool. Kid's fine, but it takes a very expensive hospital trip. And the parents sue you. That is all on you as an individual, as well as on your company. That means that they can take your house, they can take your car, they can take your savings funds. You are 100% responsible. You are identical. Additionally, with liabilities, we always say what your financial liabilities are. So liabilities with a sole proprietorship is that you have limited capital. If you have loans, they're in your name. You don't have company loans. You can't have investors because you're by yourself. So you have that 100% full liability. So Lauren, what about taxes for sole proprietorships?
Yep, so since this is the default structure, if you start a business, you start making sales, even if it's a side gig, a hobby, you're making sales, it needs to be reported on your income tax return in that tax year. So this structure as sole proprietor is on your annual income tax return. That's the Form 1040. And then there's just another form that we add on there to report the business profit or loss. So all of the revenue, which is the sales, and categorized expenses need to be listed out on this form. And then if the business has a profit, luckily for you, you get to keep all the profit because you're the only owner. But that profit is subject to a couple of different kinds of taxes. So one is your individual income tax rate at the federal level. You've got state income tax, which in Colorado is about 4.5%. You also have self-employment tax. So this is a 15.3% tax on your business profit, which is Social Security and Medicare taxes. So at the very least, make sure that any profit that you're making, set aside enough to cover these taxes.
Great. So this is our easiest one. This is where most people start out, but we don't spend a ton of time on it because it's all the defaults. A partnership is very similar to a sole proprietorship, but the difference is that you're two people. So I told you that as soon as you're making a sale with a sole proprietorship, you're a sole proprietorship. Well, as soon as you and another person start doing business together, you are now a partnership, and you're now a legal partnership. So when people ask why they need contracts for independent contractors, the answer is because if you don't have that contract, the default is you're a partnership. Doesn't matter what that understanding is, or the default is that they're an employee, which is a different topic for a different day. But partnerships are also automatic. They're with anyone, more than one person who are doing business together. They can have some formalities. Obviously, there's a shared management structure. The assumption is that if you have a partnership, that you are both or all three, I'll usually say both, I will assume there are two of you. You're both responsible for all of those decisions. You're both responsible for all of those approvals. You can't say in a partnership, oh, well, they did this behind my back. Doesn't fly. You're responsible for that, and you're responsible for keeping up with each other. We do recommend that if you are going to have a partnership, that you do a partnership agreement that sets out those requirements and responsibilities that each other has. Doesn't mean you can delegate it away entirely. Each partner will always be responsible for oversight on the other one, but it is helpful. However, like we said, a partnership agreement is not required to have a partnership. And you don't have to have an EIN, but it is recommended and can be helpful for you as you're conducting your business. So with liabilities with that is what's called joint and several liabilities. So with a sole proprietorship, you're one and the same. Well, with joint and several liabilities, you're also one and the same, and that means you're both one and the same. So let's say that your partner is the one who, that you guys have a babysitting company, and that your partner was the one at the house while they fell into the pool. And the family comes back and sues both of you because it's your babysitting company. Let's call it the Babysitters Club. No IP infringement there. Joint and several liability means that each of you is responsible for the liabilities of your company. And that if the one who was out by the pool runs off to Mexico, now you, who were not there at all, is still 100% responsible for those liabilities. And then it's up to you to go chase down your partner to get the rest back if you want to do that. So with partnership, one person can be left entirely on the hook for something that is done on behalf of the company. So it can be very risky. However, you do have more access to capital in a partnership because you have both of the partners' finances. And when anyone invests, they become a partner. That showing of the contribution of money is the bringing in of a partnership. So similarly, if you're ever investing in something and you're not seeing the paperwork that shows that this is a corporation or an LLC, be careful. You may be becoming a partner into something and you now have equal responsibility for what is going on. So Lauren, what about the taxes with a partnership?
So this is the first entity we're going to cover that is considered a pass-through entity. And what that means is there is a separate tax return for the business that gets filed. In the case of a partnership, it's the Form 1065. That's the same profit and loss statement that we've talked about before. So we're going to report the revenue, list out all the expenses. It's going to calculate what was the total amount of profit or loss from the business for the year. Then that gets divided among the partners, however many there are. And that passes through from the 1065 via another form that's called the K1. Then that gets reported on each partner's individual income tax return. That's the 1040. And so that's important in that partnership agreement that you list out what partnership percentage ownership each partner is. Is it 50-50? Is it 60-40? Is it some very random percentage? That's how we're going to allocate how much each person gets responsible for on their income taxes. So in this case, the business itself does not pay the tax. Each individual does. So that self-employment tax we talked about, 15.3%, that's still applicable to general partners, which we'll get into that nuance, I think, on the next slide. So general partners, and if they receive guaranteed payments. So another thing that should be listed out in the partnership agreement is if you decide, regardless of what amount of profit this business brings in, we're going to guarantee that each partner brings home a fixed amount of, it's basically salary, but guaranteed amount of income from the business every year. So that is both subject to the 15.3% self-employment tax, but then a limited partner are not subject to those taxes. And yeah, we can get into a little more detail on that on the next slide.
Well, and Lauren, before we go there, since
Sure.
you don't have to have a partnership agreement to have a partnership, what happens with the profit division if they don't have an agreement?
I think, I don't know if there is a default just 50-50. I think we kind of get our best estimate of anything that was in writing, whether that was emails or anything saying, what do these partners even roughly agree on or verbally agree on? But that is why it's so important to get this in writing and signed by both of you from the get-go.
Yeah, and for anyone who has a partnership, we have seen some issues before where they didn't have a partnership agreement and they were in different agreement as to what had happened. And what they ended up going with was what the tax forms had been the last few years, which one of the partners had been doing and the other one hadn't really been seeing, but again, is responsible for. So really important if you're doing these partnerships, be careful of what you're doing and see that it's in writing.
Sure. And there's one other note on that is one partner needs to be delegated to be the tax matters partner. This should also be in the partnership agreement. Only one person needs to sign the tax return. Both of you are responsible for what's on it. One person isn't going to sign it, so you have to decide which person's going to be the signer.
Great point. Glad you brought that one up. Always an important one to have that tax matters partner. So then we told you that there are different kinds of partnerships. So the one that I explained in the last one is just kind of your general partnership, the assuming that we're all kind of equally responsible for everything. But we have these other kinds of partnerships that we alluded to: limited partnerships, limited liability, and limited liability limited. And what this does is this kind of separates out that joint and several liability that we were talking about, as well as some of those other responsibilities. So for example, in a limited partnership, you'll have one general partner and one or more limited partners. The general partner is the only one with that full joint and several liability. So if the babysitter by the pool is not a general partner, babysitter by the pool may not be responsible for the damages to that child. However, if that other person who wasn't even there may still be, and it may be up to them to have to cover that entire thing if the company can't. Limited partners will then only have limited liability. So limited partners will only have liability, we call it up to the point of their investment. So they can only lose what they have put into the company, as well as always, the exception for all of this is if somebody does an intentional or criminal act while they're working for the company. We're obviously talking about personal responsibility at that point, not company responsibility. But overall today, we're going to when I'm talking about liability, we're going to assume that I'm just talking about negligence that would be responsible, the company would be responsible for. To have any of these kinds of partnerships, you must have a partnership agreement. You can't just say, oh, we had a handshake, a limited partnership. You have to have a partnership agreement for this. And the general partner will be that centralized manager. They'll be responsible for the day-to-day operations. They'll be responsible for making sure that everything runs smoothly. The limited partners, limited liability, limited responsibility, usually some limited investment as far as that goes. Limited liability partnership is similar, except that there's no general partner. All partners have limited liability when it comes to others in the company, full joint and several liability when it comes to the actions that they themselves have done on behalf of the company. And then limited liability, limited partnerships, kind of the combination there. The general has the limited liability from the limited liability partnership, and everybody else is still the same limited liability. Say those 7 times fast. So I think, Lauren, the tax considerations, going back to the last slide, for the limited partners versus general partners.
Yep. So it's, yeah, so it's just that in the general partners are going to be subject to that 15.3% self-employment tax, and same with any guaranteed payments that are guaranteed for each partner. Limited partners are not subject to that self-employment tax. And I think an important thing to consider in this is the participation of each partner, whether you are active or passive in the day-to-day functions of the business. So if you are helping run the business day-to-day, you're active and you therefore may be subject to the self-employment tax. But if you're really acting more of an investor and you're not really involved in the day-to-day operations, you can very likely not pay that self-employment tax.
That's a great point, especially because these limited partnerships and their variations are very popular, or were very popular prior to the advent of LLCs with licensed organizations. So especially if you have a founding partner or somebody who is working hard with the company for many years, but now is really only in there occasionally or for special clients or kind of to keep the name on the sign or for that passive income coming in. They may have once been a general partner, but now that they're not quite so involved, they may be more of a limited partner and not subject to some of those responsibilities and requirements of a general partner. So a thing to think about as far as that goes. Now, we started with sole proprietorship, went up to partnership. We're going to skip LLC and come back to it because it's kind of a combination of those low end plus those high end. So we're gonna, oh, no, we're not. Usually I skip LLC. Yes, all right, we'll do LLC here and that will be fine. And then I think Lauren at the end of doing all the corporations is going to explain some of those taxation differences. So limited liability company, this is exceptionally popular because it is that middle ground between your sole proprietor partnerships and your corporations. It has more liability protection for the owners than your sole proprietorship and partnership. So those are those full responsibilities, but it has more formalities than them, but it has fewer formalities than a corporation, but also a little bit less protection than a corporation. Limited liability company, we like to call it kind of the choose your own adventure organization because you can really customize it in just about every way that you can think of. So with formalities for a limited liability company, you can choose your form of management, whether you're member managed or manager managed. Member managed means that all of the managers, or all of the members, sorry, have equal responsibility over those day-to-day actions, kind of like that general partnership. Manager managed is more similar to that limited partnership where you have that one general partner who is responsible for the day-to-day. So if a limited liability company choose manager managed, the members all every year elect a manager to run the day-to-day operations of the company. The only things that get left to the members are profit distributions, dissolutions, removal or addition of members, and the voting on the manager. So the manager is very similar to a board of directors of a corporation, but instead of being a lot of people, it's just a single person, which can be very helpful. You also do need some documents when you're doing a limited liability company, and you need separate finances. We always advise people, and this is not all in the statute per se, this is a combination of the statute as well as case law that we've seen over time, as well as just kind of practical considerations that people have taken into account. To really be considered a limited liability company and not just a company saying you're a limited liability company, you need to have an operating agreement. You need to do your Secretary of State filings. You need to have annual meetings where you review things like your operating agreement and the way you're running your company. And you need to keep your personal and business finances separate with a separate business bank account. And anytime you transfer money to or from the company, it needs to not just be a transfer. It either needs to be an investment, capital contribution, or on the other side, a profit draw, payment, or reimbursement. So you have to do that kind of paperwork, which is more than you had to do for those partnerships. I mentioned an operating agreement. That is the contract between the members of the company and the company itself that says how you're going to run. You may also have some SEC considerations for limited liability companies. The SEC is the Securities and Exchange Commission, and it governs the transfer of securities, basically investment properties, promissory notes, stocks, interests. So those things where you exchange money for the promise of future money, either in interest or in profits. So an LLC may have, if you're going outside of those managing members of the company, filings with the SEC that they have to do. But a limited liability company can also choose how they vote, how they make decisions, whether they want to be majority, 2/3, unanimous, any of those things. It's really a choose your own adventure. In exchange for that, and in exchange for doing those formalities, the members get limited liability. Here's the members, here's the company. The only thing that they can lose is up to the amount of their investment. They may not get their investment back if something happens with the company, but if they've done things correctly, their house is fine, their car is fine, their savings are fine. It's separation. Now, it's not quite as far apart as with a corporation, but it's still good separation. Now, if you don't do those formalities, we call them walls, then somebody could always reach out, grab that member, and pull them in for liability in a move that we call piercing the corporate veil. So this is why the formalities are very important. Limited liability is for the managers, the members, and the officers, so long as those people act in good faith in the best interest of the company, and don't make any of those personally intentional or criminal decisions. An LLC is also nice because it has greater access to capital. So the financial liabilities can be spread out a little bit. Banks will loan to a limited liability company with a valid operating agreement. Other individuals may invest in a limited liability company. You can have passive investors in a limited liability company, and you may be eligible for some grants and other financial sources. So just a much wider world to choose from. So, Lauren, what about the taxes of that limited liability, single member limited liability company?
Yeah, so if you're a single member LLC, you are taxed the same as a sole proprietor, like we talked about a couple of slides ago. So no separate business tax return. It's on your 1040 again. You get to keep all the profits if it's just you, and then you've got self-employment tax to pay on that as well. If we're talking about an LLC that's owned by multiple people, by default, that's a partnership. So when we talked about that last, that's the Form 1065. The profit is distributed among the partners via the K1 and then taxed at their individual level. An LLC can also be taxed as an S corporation, and that is what we'll get into here in a little bit. And then we'll do a comparison of an LLC, a single member LLC, and an S corporation, basically making the same amount of money and what the tax differences would be there. So basically, an LLC, you're either taxed like a sole proprietor if it's just you, or a partnership unless you make the election to be taxed as an S Corp.
So, Lauren, am I correct in saying that the IRS doesn't recognize an LLC on its own as a taxable entity?
That's correct.
Okay,
So we'll ask a lot of people, like, so, what's your business? Like, I'm an LLC. So if, to me, by default, if that means it's just them, that's just on their tax return. They have another person, it's a partner. That it's not such a simple answer to say I'm an LLC. That doesn't really tell me how you're taxed. So, like, there's more to it than that.
Right. So when we were saying that LLC is a choose your own adventure, it's a choose your own adventure in taxes too. You have your defaults depending on how many of them you are, but you can also choose to go a different route, different adventure. And that's why it is always important to talk to both your accountant and your attorney before determining your pay structure within your LLC. And this is also applicable because different tax structures will have different employment responsibilities, and it will also be important to determine how you're getting paid for your taxes, but you may also need those forms from your attorney.
And I'll say on that note, if you're an LLC, single member LLC, you don't have to pay yourself through payroll. You don't have to pay yourself as a salary. You're paying taxes on all the profit from the business. So whether you take it from the business as a distribution or if you leave it in the business to invest, you're still paying tax on it. So at that point, you don't. And then this next entity that we get to, the S Corp, that's where things start to change.
Absolutely. So the S Corporation is kind of your next one. So it's if you're doing a full S Corporation, so not an LLC taxed as an S Corporation, but a legal S Corporation, you're going to have even more space between you and your business. Even more walls are there. But the walls mean the formalities. You're going to have more things that you have to do. For example, you can't be member managed anymore. You must have a board of directors. We recommend a board of directors being at least 3 people. Otherwise, it's not a board, it's a manager. Also, odd numbers are nice because they break ties. You have to have bylaws. You have to have meeting minutes. You have to have a stock transfer ledger, even if you don't have the physical certificate of stocks anymore, like most of us don't. You are recommended to have quarterly meetings rather than annual meetings. You must still have the annual meetings. You must have board of director meetings as well as member meetings. Again, you may have SEC requirements. And S corporations are particular in their formalities of we have to make sure that all of your members follow those restricted membership requirements of fewer than 100 shareholders, which isn't a problem for most small S corporations getting started. No aliens, meaning no international organizations starting a subsidiary that is an S corporation, and only real people, so no subsidiaries at all. You can't have an LLC owning an S corporation or another corporation owning an S corporation. Now, what this transfers to is exceptionally limited liability for the members. Only up to that point of the investment, completely separate for the owners if you follow the formalities, because the owners are even further away from the day-to-day than the board of directors. The board of directors will only have liability if they violate those acting in the best interest of the company and acting in good faith. Officer liability, meaning those people who are kind of taking those day-to-day things off of the plate of the board. Same idea, as long as they're not personally responsible for things that have happened, that they're acting in the best interest, they're acting in good faith, then they'll be in a good position. And officer also can be that tax partner, the treasurer of sorts, as far as that goes, as long as there is also a member who is responsible for that. You can have investors, but not organizations. So you can get loans from banks, but you can't have a business who is regularly invest in an S corporation. That's not permitted. But if you do this, it is much harder to pierce the corporate veil with an S corporation than it is with a limited liability company. It's just more work. And then the taxes for this, Lauren, how does one tax an S corporation?
Sure. So to become an S corporation, the business, so whether it's an LLC partnership, or a corporation has to file an election form with the IRS. That's called Form 2553. I recommend having an accountant or an attorney fill out this form for you because you want to get it right. You have to list out all the shareholders, how many shares they own, all the dates. You really want to get that right. So once you've been recognized as an S-corporation for that calendar year, this is another pass-through entity, like a partnership like we talked about before. So this form, the tax return that needs to be filed, is Form 1120S. That's due March 15th every year. And the same thing where the profit is going to be distributed among the owners via the K1. So if you're the sole owner, 100% of it is going to pass through to you. You know, whatever your percentage ownership is, you'll be responsible for the tax on your individual income tax return at whatever your individual income tax rate is. So a big difference from the LLC and partnership in this way is that the owners of an S corporation have to pay themselves a reasonable salary through payroll. So that means having income tax withheld from your paycheck, having your Form 941s done every quarter. You're paying in your taxes quarterly via payroll, just like you're an employee of the business and you're paying yourself as if you're an employee. And so the difference is where that salary amount that you're paying yourself, that's subject to the 15.3% self-employment tax, so our Social Security and Medicare. Any distributions that the owner takes above and beyond their salary are not subject to that 15.3%. And all of it's subject to federal income tax and state income tax. So when we're ready to move on from this slide, we're going to look at a comparison from an LLC and an S Corp and see how they're taxed. So in this situation, we're looking at an LLC. This is a single member LLC, and an S corporation, also a single member. In both scenarios, we're looking at $100,000, just for easy numbers, in profit that this business is going to make. So let's look at the differences. If you're a single member LLC, so how you're taxed is on your 1040 with that Schedule C. So you are subject to that full amount of self-employment tax on the profit. So $100,000 is subject to, I split it out into two categories because that 15.3 is divided in two. Half of that is the employer share, half of that is the employee share. In total, it's the 15. Now, when you're an employee of a company, you, the employee, pay 7.65% and your employer pays the other half. You may not know you're paying it because it's withheld from your check and your employer remits it. So when you're self-employed, you're both, your employee and your employer, so you're subject to both halves. So in this LLC situation, we've got $76.50 for both of those shares, and you're paying on the full amount of profit. I estimated what at your individual income tax at the federal level, what that might be. If you're in a 12% bracket, it would be around the $67.40. This will vary widely depending on if you're single, married, how many kids you have, if you get the standard deduction or itemized deduction. So this is just an estimate for illustration purposes. So there's your individual income tax, and then state income tax is 4.63% of your federal income tax. So in this situation, the total tax that you would pay is about $24,755. So if you're an S corporation, say an appropriate salary amount for you is around $50,000. And how you would determine that is if someone hired you to do the job that you're doing, what is that salary amount? And I think the best way to do this is just do some market research. Google it. What is the average salary for your years of experience? And it's tricky because you as a business owner, you're doing probably a lot more than an employee would do. But you would want to save this kind of information in case you ever got audited. They would want to know they would figure it out for themselves by the same process of what's an appropriate amount to pay yourself. So say $50,000 is appropriate for you. And then you only have to pay this self-employment tax on the amount of salary. So we get to cut this amount in half for the employer share and the employee share. So we're doing $38.25 for Social Security and Medicare on these earnings. Now your individual income tax is going to be a little bit higher under this scenario. One thing that's going to change here, there's a deduction called QBI, which stands for Qualified Business Income. Under this structure, it changes a little bit. So say your individual income tax is going to go up a little bit, and same with your state income tax. But if we add all these together, the total here, you're paying less tax than you would as an LLC. And the savings difference in this scenario is almost $5,000 for this year. And what you want to consider before you decide, yes, I need to become an S corporation, if it's going to be cost efficient, once you factor in, you have to pay yourself payroll. So you need to probably hire a payroll provider. They're going to have a monthly or quarterly fee. And then your accounting costs are probably going to be higher because there's another tax return that needs to be filed. So, you know, if after all that and your administrative, your time and all that, if you figure out that transitioning to an S Corp is more worthwhile, it's worth pursuing.
Now I'm going to bring up two things to tack on in there.
Sure.
The first is what you just said, which is transitioning to an S Corp. So we've been talking about these and how easy they are to how difficult they are. It is always easier to move up the difficulty ladder than back down the difficulty ladder. And in fact, Lauren, isn't there a penalty for moving from an S Corp to a single member LLC? Am I making that up?
You only want to change your tax entity once every 5 years. So you can't just switch back and forth every year and like, I'm making more this year, I'm making less next year. You can't just do that. You really need to decide for 5 years, we're going to be an S corporation. And you really don't want to be an S corporation if you're running at a loss or if you're at a small amount of profit. It really just doesn't make sense to have these additional administrative costs. And that's why I always advise you start with an LLC, like you're saying, go up. Start with an LLC, and after you cross this profit threshold, then you transition to an S Corp. Or if you've been an S Corp for a while and you're like, this does not make sense for us anymore, then you can dissolve the S Corp status, but know that you're not going to be able to just switch back very easily.
Perfect. The other thing I wanted to bring up, just because we get some confusion on this a bit, salary versus profit. Legally speaking, profit is what you get for who you are, and salary is what you get for what you do. So you can't actually legally take a salary simply by virtue of being an owner. It must be for work that you have done in the company and equivalent to that work. Profit, on the other hand, which some people call owner's draws, is work that you get, is money that you get just because you're an owner, and that's what compensates the ownership work that you do. So think of it, the equivalent is if you have a small child. You pay for their food and their clothing because they are your child. That is who they are. That is their profit as part of being your child. You give them an allowance for what they do. You give them extra spending money for the chores that they do or the grades that they earn or those kinds of things. So just as a helpful distinction there, while Lauren was talking about that difference between salary and profit. And Lauren, do you have anything to add on that point? Or?
No, I think that's good clarification. We tend to use those terms synonymously sometimes, and it just depends on the context. So sometimes we say owner draw or distribution. Those are usually used synonymously, or profit draw. And yeah, it really just depends on the context of how it's taxed, of how you're taking it out. But in the tax purposes, we kind of have two different ways. Like either the profit, the entire amount of profit is taxed, or the salary and then the remainder of the profit are taxed in different ways. And that's in the scenario of the S Corp.
Perfect. Perfect, perfect. So yeah, so we have one last one and then we can open it up for questions. And this is the C corporation. This is the big one. And we rarely recommend that you start with a C corporation. There are a few good reasons to do it. But it has the most formalities, even though it doesn't look like it compared to the S corporation on the slide, just because we don't have those restrictions on membership. So you must have a board of directors. You must have bylaws, you must have quarterly meetings, you must have annual member meetings, you will have requirements with the Securities and Exchange Commission on the transfer of stock and shares. You will have requirements on the recording of stock and shares. However, you're not limited as to who can be a member of a C corporation. When you are a C corporation, you have the most protection from liabilities. The owners are so far away from liability for this. The most they can lose is their investment. Think, for example, if you are currently invested in Apple, if there's a products liability case with the next iWatch, you as a 0.2% stockholder are not going to be personally responsible for that. However, you might lose your 0.2% investment. Again, like with everything else, this is only if you follow those formalities. If you were to stop following those formalities, those walls start getting lower, paper thin. If it looks like a duck, it quacks like a duck, it's a duck. If they say you're not looking like a C corporation, you're going to start looking like that default, either partnership or sole proprietorship. And you can absolutely have investors. You can have multiple stock classes, which you also can't have with an S corporation, didn't mention that. So this is where you can have that difference between active investors, passive investors. You can have people who get priority over getting that return on their investment. You can have employee stock plans that will give employees particular benefits from being owners. So there is a lot that you can do with the stock in a C corporation, but it's a lot of paperwork. So Lauren, how does a corporation get taxed?
So this one's pretty different. This is the only entity that we've talked about today. It's the only tax entity that the business itself pays the tax. In every other situation, the individual pays the tax on the profits of the business or the salary. This is the only one, the business itself. So corporations are taxed at a flat 21% tax rate, which is also different because the individual rates are in brackets. The more money you make, the higher in the tax bracket you are. The individual rates go from 10 to 37%, whereas the C Corp is just flat 21. So that may be beneficial if you're making really big money from this business, where the C Corporation is a lower tax rate than your individual tax rate may be. But in this instance, C corporations get what's called double taxation. So this business itself is taxed at the 21%. And then if the owner of the C corporation takes money out in the forms of dividends, that's after the tax has already been calculated on the profit. And then the dividends at the owner level are taxed again. So the exception to that is if owners are taking salary, that salary amount gets deducted from the business. So that's not really double taxed, but the salary amount is subject to Social Security and Medicare taxes. So it really just, again, it's not the best entity selection in my opinion for, like I said, for a lot of reasons. But in terms of the taxation, most small businesses are not going to benefit from being this kind of entity, and I would recommend more the LLC or S Corp structure. But it's worth sitting down to talk with someone if it's a good entity choice for you.
Yeah, typically we'll only recommend a C corporation to start with if either you're a foreign subsidiary, because there are so many limitations on foreign subsidiaries for the other tax classes and legal structures, or if you are true, you're looking at getting significant investors within your first couple of years. and that your structure is based on getting a lot of preferred stockholders in there. And if you're not one of those two, we would have a very serious talk about why C corporation would be the right choice for you at the outset, from my personal opinion. So, so other considerations that we do consider, though, and that this kind of goes along with what we're saying, when you're thinking about what entity to have, we talked about the formalities, the liability protections, and the taxes. However, it's also good to consider what you're doing. Certain businesses will kind of have an assumption or a default for different structures. So if you're a tech startup, your investors may expect you to be a C corporation. Similarly, if you really and truly are just selling crafts online, you may not need a full LLC as far as that goes. You may be more comfortable with it. But there are sort of some industry standards that come along with what you're doing. It's also important to think of who you're doing it with. Is this with your spouse? If so, you know, the taxes are going to be much simpler. Is it with your best friend growing up? Is it with this person who your friend knows who happens to be helping you out, but you really just met them like 8 months ago, you really like them, you're really on board with the same project? You may want to put some additional protections in there depending on who you are doing that with. It's also whether you're willing to keep up with the formalities. We talked about a lot of the formalities. If you're not willing to put in the work to be an LLC, you probably shouldn't be an LLC, because you're not actually going to be one if somebody brings a lawsuit. If you're not willing to do an operating agreement, even as a single member LLC, you may want to consider being a sole proprietor, because otherwise you're just kind of putting forth a name that isn't actually what you are. And then other tax considerations that may come in there. Lauren, do you have any other tax considerations that they should think about when they're choosing their entity structure?
Yeah, so I'll touch on the state tax portion. You'll sometimes still get questions if people want to set up their LLC in Delaware or in Wyoming, because Wyoming doesn't have a state tax. You need to set up the legal structure, in my opinion, in the state that you're doing business. You're not going to avoid taxes just by having the business entity in a different state. You are taxed in the state that you're doing business. If you're doing in Colorado, you're taxed in Colorado. There's also e-commerce. You know, a lot of us are doing business across the country or maybe even across the world. So you may have state tax responsibility in other states. So make sure that you are aware of that. You also may have sales tax requirement, especially if you're selling products or marking up products, even food, all kinds of stuff. So definitely talk to your accountant, see if you have sales tax requirements. And then lastly, I wanted to note that there are certain in entity structure, for example, like retirement accounts, how much you can contribute and which accounts you can have may vary based on what structure you have. So if you're really looking to optimize and put away a lot of tax protected retirement accounts, also talk to someone to see which one would be best for you.
Awesome. Well, I guess, Hannah, what questions do you have for us?
Yes, thank you guys. That was such a great presentation. A couple questions did come in, and this first one I think you touched on briefly, but if you could just clarify, that would be helpful. The question is, can you have an LLC that is owned as an unequal partnership? For example, one person owns more than 50% and the other person less than 50%.
As long as it is in your operating agreements that is what it is, then you're fine. Legally, generally, the default is if you don't have it written down, you're deemed to be equal. And Lauren was saying that, you know, for tax purposes, they'll look at other things. So as long as you write it down, you can have whatever percentage you want.
Great, thank you. That's really helpful. Another question, can you please address the nonprofit corporation? Some general components and requirements in Colorado, but not necessarily the 501(c)(3) issues, just the Colorado requirements as a nonprofit?
Sure. Super briefly, honestly, it's mostly the same as whatever base entity you have. So you can have a nonprofit LLC or a nonprofit corporation. If you have an LLC, you need the operating agreement. If you have a nonprofit corporation, you need the bylaws. The main distinctions there are that you have to have your not-for-profit purpose designated. And for most businesses, you don't have to designate your purpose in the state of Colorado as long as it's a legal business purpose. So you have to designate your educational, charitable purpose. You have to clarify you're not doing any lobbying unless you're a 501c6. And you have to have a game plan for distribution of assets on dissolution that follows the IRS code. Lauren, anything else that needs to be?
Yeah, that's really it. I mean, if you're looking to get that status and be a tax exempt organization, know that as the owner and as employees, just like we were talking about the salary before, if you're doing work in that organization, you yourself are getting compensated for what you're doing, that doesn't mean that's going to be tax-free income to you. So a lot of people are like, oh, we'll start a nonprofit and we won't get taxed. Like you, if you're doing work in the business, you're still going to get subject to tax. Although, you know, if the tax exempt status is granted and you are that kind of organization, any profits, if you were their nonprofit profits, will not be subject to those kinds of income tax.
Great, thank you. Last question we have right here. Is there a time of year that is best to change structure? If you do decide you need to change, you know, thinking that it could be messy to then report on 2 different types of structures for within one tax year, what would you recommend there?
So I say you can do it at any time of year. There are times of years that I would say are easier. So if for simplicity's sake, if you want to end one tax year and say for 2020, we were an LLC, for 2021, we're going to be an S-Corp, I think it's cleaner to do it that way. And that form, the S-election form, the 2553, that is due by March 15th of the calendar year. So for 2021, if you want to be an S-Corp, that needs to be filed by March 15th of 2021. It can be filed late. It's just a little bit of extra administrative work to say why it's late. So for simplicity's sake, I would say that early part of the year, January, February, is a good time to switch structures. And if you want to work with an accountant, get in January before tax season hits, before they get too busy.
And also, similarly, if you want to work with an attorney on that, sometimes it can be best to let us know about that in October, November. That way we get all your paperwork done and it's ready to go on January 1st, that we can do late effective. So that when you're hitting your accountant, you're like, I have all the legal paperwork done, it's ready to go. It's effective January 1st, 2021. So always good to coordinate with your accountants and attorneys.
Great, those are really helpful considerations. So thank you for those answers and for all of this information. Like we mentioned in the beginning, we will be sending this out, so you do have access to it. You know, after this ends, we'll get that out to you later today. So thank you all so much for joining us. And Samantha and Lauren, thank you for your time and all of your knowledge. Please visit our website. It's northmetrosbdc.com to set up a consultation or for any further questions and our other resources on our website. So thank you all for joining, and we wish you a great rest of your day.
Have a good one, guys. Thank you.